it's normal or not, but from
Right.
what we've, what we've been, and I think you got to call it fortunate. If you're an options trader, futures trader, you want things to move. So how do we trade low volatility? And I'm curious to hear your thoughts coming from the options side. When you look at low volatility, we like volatility contraction. Once it's contracted, we're not so thrilled to, and we change what we do in terms of opportunity. How do you look at this lower volatility environment we have right now, and how do you find or start to set the table? What changes for you, Jermal?
Yeah, no, I like this, and I like. I'm curious to get your thoughts from the future standpoint. I mean, this is the chart. This is the guy, the VIX. I mean, look at what happened. Look at what we saw. We went from a high of 89, I think it was, intraday, to where we are now. We saw that quick steep drop. It was faster, a faster drop to like below 25 than what we saw in 2008-9 area. And now we're sitting in this range of 15, 16. Long-term average of the VIX, they always say, is 19. So we got pretty low VIX. And I was just looking before the show, SPX historical volatility, meaning the moves over the last couple of days. 10-day vol is a 6, like 7.
Right.
We're not moving. You look at SPY vol for July, it's 11. So while there's all these macro themes and all these things that are happening, we're not moving. However, we do have a lot going on. We have these meme stocks, from the standpoint of stocks and trading and options. We got a lot going on with the meme stuff. We got a lot of volatility. I shouldn't say a lot of volatility, but some volatility in Bitcoin.
Right.
And I say because Bitcoin can be a heck of a lot more volatile. But we got some Bitcoin volatility happening, which is affecting the other cryptocurrencies. We had the jobs number last week. We talked about that. And we saw what we saw was a pullback in the dollar, a pullback in rates. Rates dropped below 16. Dollar's done its thing. So, I mean, there's a lot happening, I think. And so you can get lulled to sleep. So a lot of times in the past, I've traded in these type of environments. It's different times. So when I was trading at a firm, we were always looking at this type of situation, and we would trade what was happening. We would trade the trend. The trend is low vol, so we would sell. And we would stay short. There's people who would get even shorter at times like this.
Interesting, really.
Yeah, I mean, especially the guys who love to sell, they would say, oh, okay, vol 16, now it's going to go to 13, 14. Or I should say VIX is 16. Now it's going to go to 13, 14. I'm going to sit here, or it's just going to sit here for the time being. We don't have any big events coming up. Mm-hmm. We do have a Fed meeting next week, but I mean, we're the Fed right now is basing what we're getting from the Fed is all about inflation, and we're getting those inflation numbers. We got a CPI number coming on Thursday. So a lot of people would look at that and say, we're going to get short and we're going to stay short. Now, that's a little bit contrary to what, I've learned here coming to Tasty, which has been a little bit different. We look at different levels of the VIX and we say right now, we're not going to be that much in. We're still going to be short, but you're probably only 20 to 30% of your buying powers being used right now versus 90 to 100%. So those are all my thoughts around this type of environment. I'm, really not that surprised given what we came out of. Just if I kind of, they say the history rhymes. So I think right now what we're seeing is similar to what we saw in 2009, where volatility is coming in. A lot of things are moving around, but the idea here is normalizing. When do we get to normal?
Right.
I'm curious to hear what you from the standpoint of in this type of environment, how you trade futures. Like, what do you look at? What do you do?
Right. And, it's a great, you make a great point. I find it fascinating. And we've seen this is that especially larger firms tend to push harder when it's lower. And the idea that, and I've wrestled with this idea is like, if I'm not going to sell a ton of vol at 30, why would I be, selling my kidneys and everything else institutionally to sell it at 14 with the trade down to 12? But you see that, and whether it's a hunt for a certain amount of return or whatever, it always fascinates me that you do see that almost very paradoxical to what we do at Tasty Trade. Absolutely. For me, and John, if we can jump one slide ahead, volatility, futures trading is great because it takes two components to it. And John, if we can jump just one slide ahead, that'd be great. Thank you so much. You've got the options on futures piece, which obviously is directly reflective of, the opportunity is expanded with higher volatility, but smaller ranges or lower vol and smaller ranges don't mean we have fewer opportunities. I think for me, from my standpoint, is much like the guys who you mentioned who are always engaged, whether vol's at 14 or 44, they've got a strategy to find a return on that. For me, it is. And Spree's a great example. We had a daily movement out to $1.25 in April and the first half of May. We're into 75 cents. So you think about that, we're almost half in terms of that daily range. That's that daily range directly reflective of volatility. Is there still tradable opportunity? You would think, well, the $1.25 was rich, and it was. The 75 cents is still opportune. And as you said, it's around normal. So, and you mentioned that VIX level around normal and the tradable event here. For me, it is, okay, so my expectation of entry and exit points is less. If I'm going to wait for $1.25, I'm going to have much fewer trades on. So can I wait for that? And absolutely, but that is just going to keep you much less engaged in the market. So what I look at is, okay, the market, and we've talked to, whenever we say the market should be here or it should give me, then you should move on to another product, because should is never a good statement in a strategy. But if I'm willing to accept this more normalized range, and I think you used the perfect term for it, I'm going to lower my expectations down. I'm still going to stay engaged, but what I will do is probably lower my size a little bit. So much differently than in the world of, as you mentioned, from that institutional option side, where they're going to possibly increase their size because they're looking for the same returns with smaller movement. I'm going to accept the fact that the smaller ranges are going to lower my returns if I'm profitable, but they're going to let me participate in the market. And they're also going to let me scale into opportunities. If we do go, the greatest thing for me and challenge was, and I'm probably going on too long, is adjusting my style and my size when the market's changed, hoping that $1.25 range will come back in 2 days, and trying to force strategies around opportunities that don't exist. So I'm very quick now to adjust my size down and my expectations down. And I found that is a very productive way to still stay engaged while the expectations of movement are diminished.
Well, I mean, you touched on that you're not going on too long, because that was the gym. And that's exactly, I think we're kind of saying the same thing here. We are. It's kind of the training that you get when you're working at a firm. You do struggle to get away from that when you start to trade more on your own. It's a different type of thought process. And, to with the idea of options, yeah, I mean, like I said, you have that ability to put on more size in those type of situations in low volatility environments, anticipating the market kind of sitting still, but then you get a quick pop. We all know that when you get lower, the big thing here is that when you get to low volatility levels, at some point or another, we might get a pop. I personally think, and this is my thoughts, for the rest of the year, could be kind of like this, but I think we're going to get pops and volatility every now and again throughout the year because of all the different things going on. I don't think we're going to get some huge correction. I know there's a lot of people out there that are expecting that, but I think we're going to get little pops every now and again. And to your point, to be able to be nimble when we do get those pops is the key. So it seems like it's the same thing for futures.
Absolutely. And I think you and I are thinking about this spot on. Sure, a lot of people are looking for the huge rollover. Now, Bitcoin trading a little bit lower this week. Is that going to be the catalyst? And this is, again, where I think you get in. Well, if Bitcoin's going to fall, then, we should see the rest of the market fall. I don't know why. Sure, it sounds good, but it's kind of curve fitting that I think equities are overvalued. The opportunities, I agree with you, are going to, we are going to see those, as you said, those moments when we have greater opportunity come and go. Maybe a little less frequently, but I think the first half of this year was a bit of an outlier in terms of a lot of things and a lot of movement. Do we go into, it's so funny because I remember just 2 years ago trading corn. Now it's almost $7 a bushel, was at $3, $3.25, and just trading so many strategies looking for a 10-cent bounce in corn, I remember selling puts and, we're looking for a 10 cent. Now we're getting 30 cents in a day. So, Is that an outlier? Absolutely. It was the 10 cents an outlier in terms of these collapsed ranges. Absolutely. So looking for opportunity within a reasonable set of different types of markets. I think we're both looking about this the same way. And I don't know, for me, a couple things coming to mind is learning from the mistakes of not adjusting and the right amount of patience. And I think patience takes place in a number of different ways. And I'm wondering, how does patience fit into your trading strategies?
Great question, because I got a question for you that's going to feed into it. So here we go. So with this spree, right? So right now we have this inflation situation, right? And we got this inflation number coming out on Thursday. We've seen gold climb to 1900. So what if, right here, we're talking about the range, and it seems to be at the high end of the range, right? So if I'm looking at this spree, I'm thinking I'm going to get a little short here. And just for devil's advocate, say we get some number that says, oh my God, well, I think they're looking at like, I don't know, 4% in this CPI number. Yeah. Say it's 6%, and gold goes, meaning spree kind of go. I mean, gold is an element of spree. It's not right. The thing, but spree goes, I'm short this thing now, and I have an idea, but I still want to play devil's advocate just for not only myself, but the people who are watching. What do you do then? How do you decide how to close that out? Or do you just stay short that? Again, this gets to the idea of what we're talking about. So, how do you view that, in that manner? It's going against you, even though you're trying to trade the range, but now maybe the range is changing on you.
And I think we're thinking exactly like, is that I'm not going to tell the market what the range is. The market's going to tell me what the range is. And when that changes, and you're right, 79, 80 to 75 has served us really, really well for a long period of time. Now, if we do get that outlier, and you and I are not, well, you're a scientist, I'm a knucklehead. You have a much better chance of actually modeling something far better than me.
It's fine. I couldn't convince anybody I'm a scientist anymore anyway.
If we get to that 81.5 or 82, I mean, for me, 81 is if I'm short, I'm getting out. And you would think, well, why do you like the shorts at 79.5 and you don't like them at 80 anymore at 81? Well, the market is, whether it's finding a new range or just going to kind of test the upside and collapse again, I don't know. But I'm letting the market show me a new range. So for me, symmetrical mechanics, being more aggressive over management, especially within this lower volatility environment, I'm going to let the market prove to me that there is a new range, and I'll trade that new range or not. So, but I think the takeaway, and I think that's where we're both going, is if I like the shorts between 75 and 80, there's that question for a new trader. Well, why don't I like them more at 81 and 82? Why aren't I in? And I think for me, it's strategy was, I'm going to trade the range. And that means I'm selling 79.5s or 80s. Strategy is I've got a bear bias against that. My mechanics are, I'm going to manage this for 50 or 60 cent winner or a 50 or 60 cent loser. So you can't change. If that's the strategy around this trade, if we get to 81.5, you should already be out of that trade, because that no longer fits your strategy. So I think we need to stay, again, maybe there's a new strategy to be had, or maybe you have enough bullets to average. But I tend to find that if I try to adapt my strategy because the market's changed, I don't have a very good outcome, because all of a sudden those symmetrical mechanics around management change, because the market's gone through my get out point when I'm wrong. So do I have a larger elasticity in my get out point? Am I going to now risk $2 instead of 50 cents? Does that mean now I have to change my win strategy to $2? And that kind of, all those mechanics break down. So I tend to, and John, if we can jump one slide ahead, I like to keep it tight. And sometimes you and I will buy, or I will buy that high and the market will collapse down into the range from a slightly higher point. Sure, that's going to happen. But otherwise, we're changing a trade in mid-flight. And I'm not sure, I've found from experience doing that because of circumstance, it's not very productive for me.
Yeah, I mean, it can be a difficult thing. I've certainly, been on the other side of that as well, in those situations where you're trying to, usually from a long side. I mean, as I've talked about, I worked in a momentum group, and, there's plenty of times where we try to, buy something on a breakout, and there's plenty of times you try to, get short via
right.
puts on a breakdown, and sometimes you hit and sometimes you don't. But, I think what we're getting at really, Makes sense. It's interesting, looking at it from this standpoint versus the options standpoint, like looking at, how your trade entry should be and looking at scaling in. I mean, I agree. Your trade entry should be smaller and overall and more aggressive. And I'm guessing the more aggressive is probably based on price, right? Is that
Right?
Yeah. Okay. I mean, and that totally makes sense to me. And the scaling in can mean getting trades on in low vol without getting too big too early, which, again, gets to what we were talking about. I mean, in these type of environments for an options trade, you want to be smart and you want to be nimble. It seems to be the same thing here where we're talking about with futures.
You know what, you're spot on, and you really hit on that important point of I'm going to lower my expectations and you summed up. Aggressive means I'm going to accept a smaller range and I'm going to trade that 75 points instead of waiting for that $1.25. So I'm going to do it in a smaller fashion with the idea that it doesn't mean the $1.25 or $1.50 doesn't come back as that range. As you pointed out, I'm going to let the market show me that expanded range, then adjust my strategies and mechanics. So it's a good discussion of how do we stay engaged and how do we set expectations. It's fascinating to see that from that very different world, how you've really translated into that different thing. How much of that knowledge is so easily translated and brought into the world of futures in terms of opportunity?
Yeah, I mean, I was, essentially we can say I was a daredevil and I was jumping off houses. Now I'm jumping out of planes with a parachute. I mean, it's the same concept. It's just a bigger fall. It's cool. No, this is interesting because I've been eyeing up the 10-year and I've been looking at that as it's below 16. So I might kind of, this might draw my interest in this same type of methodology, and maybe I'll look to get long right now. We'll see.
Oh, that's so funny. Yeah, I was running through the 10 years, looking at the 10s and 30s, and I couldn't agree with you more on the pullback here. It really looks like an interesting trade. Jermal, thanks so much. Jermal has been really taking us all through a wonderful journey from his world of options into the world of futures, and we'll continue to do that with the next segment coming up with you and Frank on Thursday. So everyone, thanks for tuning in. Jermal, have a great day, my friend.
You too, my friend. See you.